Today, we'll have exceptional insight into credit information sharing systems and the way they affect bank behavior, especially in the context of bank diversification strategies and also the valuation of the bank. And we are exceptionally delighted because we have our very own Jeffrey Ighedosa presenting this seminar. And what he's sharing with us is his research as part of his PhD thesis, which he successfully defended in September this year. So he's Dr. Jeffrey Ighedosa. But the fact that this research spanned over a period of approximately 3 years, in which he was able to look into existing practices of credit information sharing systems around the world, and was able to uncover very interesting findings that he will share with us today. I know many of you who are from SOAS have been interacting with Jeffrey over a long period of time, so maybe you know him very well now. But however, it would be fair to introduce Jeffrey, but also in the context that this audience includes people who may be meeting Jeffrey for the first time. So Dr. Jeffrey Ighedosa is now a senior teaching fellow in financial accounting within the School of Finance and Management and Center for Global Finance, where here at SOAS University of London. As I mentioned, he's recently completed his PhD in finance within the Center for Global Finance. In terms of background, he holds a BSc in accounting and finance from Oxford Brookes University. He's also ACCA qualified and has also an MBA in banking and finance from the University of Wales, Trinity, St. David. His current research focuses on this special issue he's talking about today, which is credit information sharing systems and bank behavior. But he has also looked into issues like sustainable financial reporting, the sustainability in the context of climate risk. And he has also looked into competing financing models for small and medium enterprises in developing countries. He has quite a huge number of ongoing work, mainly as part of his PhD thesis, but also from these other extra projects that he's been involved in. Today, we are also exceptionally delighted to have two discussants with us today, and especially discussants who have not only a research background, but also have strong practitioner and policy backgrounds. In terms of the policy background, let me introduce, I have the pleasure to introduce our good old friend of the Center for Global Finance, Dr. Martin Brownbridge, who is now an independent consultant. But as you may well remember, Martin spent some time here at the Center for Global Finance here at SOAS, and I think some of you may remember the work that he was working on and his seminars that he's presented here at SOAS. So Martin, you are welcome as a discussant for this particular paper, and you bring on board the policy experiences with international organizations, but also at the Central Bank of Uganda for many years. Now, secondly, we're delighted to have with us Mr. Gabriel Davel, who is an international consultant and also with Davel and Associates in South Africa, in Johannesburg. Gabriel comes with us from a very strong practitioner background. He is a chartered accountant, but also with a master's degree in economics, he has actually consulted in all these areas, most of the areas that Jeffrey were talking about. And so we're delighted that he will be able to bring on board some of the experiences that practitioners observe in the field, and whether our work, our own research, is closer to what the practitioner world expects from us at the Center for Global Finance. So it's my great pleasure, and let me ask you to put your hands together and welcome the three three people talking at this seminar. The presenter, Dr. Jeffrey Ighedosa, the discussant, Dr. Martin Brownbridge, the discussant, Mr. Jeffrey Davel. Please welcome, and please go ahead, Jeffrey, and start your presentation. Thank you.
Thank you, Victor, for your kind introduction and for the opportunity to discuss our ongoing work. So what we try to do in this study is attempting to quantify the role of credit information sharing in shaping the optimal level of bank diversification and how this relationship affects the excess value of a diversified bank in the context of developing countries. So this is the order that I will follow in the presentation. I'll start with a background discussion on credit information sharing and the recent growth in the adoption of the two main information sharing systems. Then I'll look at the existing literature briefly and the hypotheses that we have investigated. Then in the empirical section of the study, I'll cover the methodology and the new findings and some implications. Now, the concept of credit information sharing covers the different policies, platforms, or schemes which enable banks and other lenders to routinely exchange information about their borrowers to overcome adverse selection problem. The idea is that if we have a banking sector where banks share their borrowers' information with other banks regularly, all banks will have the same information to evaluate all loan applicants, including those who are moving from one bank to another. And as more individuals and businesses in the country are included in the sharing system, banks become less concerned about the lemons problem, since accurate information on majority of borrowers who are active in the credit market can be obtained easily and less costly from the information sharing system. Information sharing can reduce moral hazard behavior as well, because it motivates borrowers to service and repay their loans, especially when borrowers are aware that banks exchange and utilize their information. In terms of who or which party benefit from credit information sharing, it can benefit both banks and borrowers, because it gives borrowers the opportunity to create a reputational collateral and increase access to credit. At the same time, it increases banks' loan screening and monitoring abilities, which help to reduce credit risk. And the way that lenders share their borrowers' information may vary depending on which scheme is available in a country. But they are likely to do so voluntarily through the Private Credit Bureau or as a regulatory requirement through the Public Credit Registry. Credit registries are usually set up by central bank to improve the flow of credit information in the banking sector. And regulated financial institutions in the country are mandated to participate and share their borrowers' information. The information shared by by the institutions is then used by the registry to create reports on borrowers, which are made available to the authorities for bank supervision and also to the participating financial institutions for credit risk assessment. In some countries with minimal reporting threshold, banks are only required to share data credit balances above the threshold set by the regulators. This is because smaller loans are not expected to have significant adverse effect on the banking sector. Credit bureau, on the other hand, are privately owned either by lenders themselves or by a third party. Although some credit bureaus are owned by the government, but participation remains voluntary for all users. Lenders are usually required to share their own information, to have access to information shared by others. And members who have shared their own information and have paid the discounted subscription fee receive credit reports upon request. So we'll be using credit registry and mandatory information sharing interchangeably in the presentation, and credit bureau and voluntary information sharing in a similar way. In addition to being voluntary, credit bureaus are different from credit registries in many other ways, including the sources of data and how credit information is used. We know registries are generally databases of information shared by the regulated financial institutions, whereas credit bureaus have gradually changed their services over the years using modern technology. With machine learning and big data, credit bureaus are now able to gather data from multiple sources and are expanding into real-time value adding services as well, including portfolio monitoring, which is a recent exposed service designed to counter moral hazard problem. Because of these capabilities, credit bureaus are developing new ways to assess the credit worthiness of millions of unbanked individuals and small businesses around the world. You remember that credit information sharing system distribute information on borrowers with credit history in the formal credit market, while those without access to formal credit, as well as those borrowing in the informal market, are left out of the system since they do not have a formal credit history to be shared by banks. And this has been a major issue in developing countries where majority of small businesses and individuals borrow informally. But credit bureaus are able to collect data from informal credit providers and many other alternative sources of information to create formal credit history for them for the first time. Because of this, there's an argument in the literature that credit bureaus provide important link between formal and informal credit markets. Although we have not covered the legal aspect of credit information sharing institutions in the study, but I think it's important to mention that this mining of alternative data, if I may put it that way, means that credit bureaus are heavily regulated. The legal framework in some countries prevent the operations of credit bureau or limit the services and information that they provide. You can understand the need for these regulations. The safety of vulnerable people has to be ensured. Credit bureau maintain database of millions of individuals and businesses, and any data breach can cause significant damage. We saw what happened about 4 or 5 months ago when Equifax was fined about £11 million by the UK financial watchdog for failing to manage or monitor the security of UK consumer data that it has sourced to its parent company in the US. We are likely to see more stringent regulations in the area of data protection, especially as these international credit bureaus are expanding into developing and emerging economies. The fact that technology has opened more avenues for data collection and data usage is another reason to increase regulation. There are real concerns that information could be used to identify vulnerable individuals and small businesses for predatory loans. However, it does not look like these regulations can prevent the role of big data and fintech in the credit information sharing process moving forward. And the use of so-called alternative data is central to this because it helps to promote access to credit for borrowers without performing credit history. When it comes to the adoption of credit information sharing schemes, there has been significant growth, especially from the late 2000s. We can clearly see in this graph that developing countries have seen most growth in both credit registries and credit bureau compared to OECD countries where registries appear to have been in place and well established for a long time. This trend is partly due to the rise in digital access to credit through various lending platforms, which are also sources of credit information. But the biggest contributor to this growth, I would say, is the World Bank Development Program, which started in 2008 when the International Committee on Credit Reporting, ICCR, was created in collaboration with the Bank for International Settlements. The committee produced the general principles of credit reporting, which have been adopted by countries since 2011 to develop their local information systems. This move was motivated by the evidence at the time that banks were not timely in their recognition of expected losses in the build-up to the global financial crisis. Information sharing schemes were then promoted to provide reliable information for bank supervisors to be able to look at the universe of credit in detail and monitor credit growth in the entire financial system. Credit information sharing, especially credit registry, can produce timely credit data for bank provisioning and capital buffers to be properly calibrated to cover both expected and unexpected losses. And this was the agenda. Because when you look at the way that credit registries are designed, compulsory participation, banks must report all credit balances above the minimum threshold, and sharing of credit information must take place through a platform administered by the authorities. The goal is to improve both on-site examination as well as off-site monitoring of banks, and to avoid completely relying on internal databases of banks. Since the creation of ICCR, the World Bank has assisted governments of many countries, especially developing nations, to establish or reform their credit information sharing systems. As many as 173 countries now have credit registry or credit bureau, and in some cases, both schemes have been adopted. Now, this is an interesting map. This is the map that shows how information sharing systems have been adopted by countries around the world. The yellow areas represent countries with credit bureau only. The orange areas are countries with credit registries only, while the brown areas are countries with both credit bureau and credit registry. What stands out in this map is that developed countries, including the US, Canada, UK, Germany, all have either credit bureau only or both credit bureau and credit registry. Whereas the areas covered in orange are mostly developing and emerging countries, indicating that these countries only have credit registry. Now, that is very interesting. And even when you look at the concentration, especially in the African continent, in this area, I don't know if you can see the cursor that moving, that's where it's focused, the African continent. This could be due to the need for higher bank supervision in developing countries, hence the dominance of credit registry, which is a supervisory tool, or because the legal framework in developing countries prevents the spread of credit bureau. Regardless of what the reason is, there is a disadvantage when it comes to access to information, since credit bureau would normally provide reports on smaller loans that are not covered by credit registries due to the minimum reporting threshold. The argument for credit information sharing is based on the asymmetric information theory, which suggests that adverse selection can arise in credit markets where borrowers know more than the lenders about their repayment prospects. Therefore, by sharing information on borrowers' credit history and their current level of debt, the financial market can function properly, and firms are able to raise funds and invest in viable projects. Theoretical studies have predicted increase in credit growth and reduction in credit risk. And the channels that support these predictions are reduction in adverse selection between lenders and borrowers, reduction in moral hazard behavior of borrowers, reduction in informational rents, and reduction in over-indebtedness of borrowers. Now, whether information sharing can deliver both benefits in all markets is a big question, because it may be the case that reduction in credit growth is the channel through which information sharing reduces credit risk in some countries. For instance, the introduction of credit information sharing scheme in a market that is characterized by excessive lending due to adverse selection problem is likely to reduce excessive credit growth in order to reduce credit risk. Information sharing can reduce credit risk by increasing bank supervision, but the channel for credit growth is not clear. When you think about it, 3 different outcomes are equally possible when banks start sharing information about their borrowers, depending on the existing level of adverse selection in the market. It can lead to higher aggregate lending if increase in credit to safe borrowers exceeds reduction in credit to risky borrowers. However, it can reduce credit growth if increase in lending to safe borrowers fails to compensate for the reduction in lending to bad borrowers. And it may have insignificant effect if increase in lending simply offset reduction in lending. The argument by Pagano, which is the first theoretical paper here, is that credit will increase for safe borrowers who were previously priced out of the market due to adverse selection problem. This is based on the assumption that adverse selection increases credit rationing. However, there are markets where adverse selection leads to excessive lending rather than rationing. And credit information sharing will reduce aggregate lending in these markets by revealing higher proportion of low quality borrowers. Well, these are all empirical questions. So I have provided some evidence from the existing literature. So the effect of information sharing on credit risk appears to be universally positive. Lower credit risk is generally reported in the literature. The study by Houston is based on a global sample of banks. It shows that greater information sharing reduces credit risk and the likelihood of financial crisis. Similar results have been reported in other studies, including Fosu, who his study of banks operating in developing countries. By addressing adverse selection and borrow as a problem, credit information sharing reduces credit risk. And the results are the same for both mandatory and voluntary information sharing systems. The finding by Balakrishna and Ertan are particularly important as they seem to clarify how information sharing increases financial system development and reduces banking crisis. The study is based on a global data set, and it finds increase in the timeliness of bank loan loss recognition practices. This implies that information sharing improves the accuracy of credit data available to both banks and bank supervisors for risk assessment in the banking sector. Now, when it comes to credit growth, the two information sharing schemes have different effects. The effect of voluntary system is positive, which means it does not only reduce credit risk, but also increase growth. In the 2002 paper by Liberty, increase in competition is confirmed as the key driver of higher credit growth associated with voluntary information sharing system. While the study by Sutherland shows that reduction in borrower switching cost is the channel through which voluntary information sharing increases growth. However, when information sharing is mandated by national bank regulators, insignificant and negative effects on credit growth have been reported overall. The study by Dehas and his colleagues in 2001 shows why mandatory information sharing system may not result in higher credit growth. In their study, it reduces credit risk, but also reduces credit growth at both the extensive and intensive margins in Bosnia and Herzegovina. According to their explanation, the credit market had a severe adverse selection problem before mandatory information sharing system was introduced. And many borrowers were granted credit facilities, including those who were not credit worthy. So it is not surprising that mandatory scheme became a disciplinary device in this market, which ended up reducing excessive lending to reduce credit risk. Moreover, this is what compulsory participation in information sharing design is meant to do, to promote transparency and discipline in the banking sector. And banks are aware that shared information is used by supervisory authority to monitor the quality of their asset portfolio. The empirical evidence so far highlights the difference between credit registry and credit bureau in relation to credit growth. The decision to grant an operating license to a credit bureau is a typical response to asymmetric information between lenders and borrowers in the credit market. Why the introduction of credit registry is to address informational gap between banks and the regulators to improve bank supervision. This difference has not been emphasized in the literature. Consequently, the potential agency cost associated with forcing banks to share their private information with other banks through a platform that is administered by the regulators have not been recognized in the literature. With this disciplinary effects of mandatory information sharing in mind, we proposed some questions in this study that if mandatory information sharing prevents higher bank lending due to increase in supervision and monitoring of credit activities, does it increase bank diversification into non-lending activity areas, since these activities are not included in the compulsory reporting system? And if the answer is yes, how does it affect the quality of diversified investment when it comes to wealth creation? Evidence suggests that when banks cannot generate sufficient profit from lending, they increase investment in non-interest income generating activities to increase fees and commission-based earnings. This is encouraged in some banking sectors since it reduces systemic risk. Moreover, diversification provides opportunity for scale economies and to create higher value for shareholders. But the problem with diversification is that although many of these activities are more profitable than loans, they are riskier too, and these risks materialize when diversification is excessive. When diversification is moderate, it generates a premium. But when it is excessive, it creates a discount. And excessive diversification is driven by agency problems. So accordingly, we predict that by forcing banks to reduce lending activities, mandatory information sharing system can incentivize diversification beyond the value creation threshold. Whereas voluntary information sharing scheme, which increases bank lending, should not result in excessive diversification, but moderate and higher quality diversified investment. Here is the summary of the hypothesis based on this argument. That mandatory credit information sharing increases bank diversification above the optimal level. And by doing so, it reduces excess value of diversified banks. Those are the first two hypotheses. The last two, voluntary credit information sharing reduces bank diversification above the optimal level. And by doing so, it increases excess value of diversified banks. Now, to test these hypotheses, we use a panel data representing 368 banks from 40 developing countries. And the period covered is 2012 to 2020. We initially collected data for more banks and countries, but there were too many missing bank level data, especially for the years before 2012. So the best we could make from the entire data is the unbalanced panel data of 368 banks from 40 countries. Now, this is the main dependent variable, which is the excess value of banks. Excess value of bank measures the performance of diversification policies in relation to value creation. We have estimated this using the chop shop approach by grouping activities of banks into lending for commercial banking and non-lending for investment banking. Then estimate the actual Tobin skew based on equation 1, as well as activity adjusted Tobin skew using equation 2. And finally, we take the difference between the two in equation 3. This represents the excess value created or lost due to diversification. In equation 2 and 3, omega 1 represents the proportion of activities of a diversified bank, that is lending, while omega 2 represents the proportion of non-lending activities. Q1 is the value that the bank would have if it was specializing in lending alone, and Q2 if it was specializing in non-lending activities. This means excess value is the difference between actual value of a diversified bank and the value it would have if it was broken into a portfolio of entities, with each entity specializing in one activity. For diversification, we use equation 4, which is an adjusted version of Huffington-Hedgeman index based on interest earning assets, other earning assets, and total earning assets of banks, which means diversification is the sum of squares of each earning asset group expressed as a proportion of the square of total earning assets. The estimated diversification value ranges from 0 to 0.5, where 0 represents a specialized bank and 0.5 means a bank is fully diversified. That is 50% each for lending activities and non-lending activities. We use 2 measures of credit information sharing: the mandatory information sharing coverage, which is the coverage of a country's public credit registry, and voluntary information sharing coverage, which is the coverage of private credit bureau in a country. This table provides the descriptive statistics, and we can see that the excess value has a mean of 0.015, which is an indication that diversification has a premium because it's positive. But when you look at the 3 sets of results at the bottom of the table, these last 3, diversified banks operating in countries with mandatory information sharing only may be trading at a discount with marginally negative mean value of minus 0.002. Whereas banks in countries with voluntary system only have higher premium of 0.023. For the measure of diversification, it has a value of 0.44, which suggests that banking sectors in developing countries are highly diversified, especially when you compare it to the maximum diversification of 0.5. The methodology. Now, we start the estimation by checking whether the effect of diversification on excess value is linear or not. For this, we specify a dynamic model, which is presented in equation 5, where EV represents excess value of banks, then DIV is diversification, X is a vector of bank control variables, and Z is a vector of control variables. A squared value of diversification is included, which indicates nonlinear relationship if significant. The expectations are that delta 2 is positive, which means diversification increases asset value of banks, but negative sign for delta 3, which would confirm an inverted U curve. If these coefficients are significant, then our next estimation is to establish the optimum value of bank, beyond which the effect of diversification becomes negative. For this, we adopt the Hansen threshold model. That is equation 6. Now, because this original Hansen model is a static model, it is not compatible with our endogenous variable, which is dynamic. So we modify the model according to the recommendation by Creamer to produce the dynamic threshold panel model presented in equation 7. Now, the parameter that we are interested in is the gamma, which is the threshold or the optimal level of diversification estimated with 95% confidence interval. Equation 7 also estimates two coefficients, one representing diversification below the threshold and the other above the threshold value. These are captured by lambda 1 and 2. These coefficients tell us how diversification affects asset value when it is below and above the optimal level. What is also interesting about equation 7 is that when we estimate it, it automatically generates two new variables, one for below and the other for above the threshold. We then use these new variables to estimate the effects of credit information sharing in the lower regime as well as the upper regime. And we have used equation 8 for these estimations, where the dependent variables are diversification below the threshold and diversification above the threshold. CIS here represents each of the two measures of credit information sharing. And finally, equation 9 has an interaction term for information sharing and diversification above threshold. And the dependent variable is the excess value of banks. This model, equation 9, allows us to estimate how the effects of each of the information sharing system on diversification in the upper regime changes the excess value of banks. Now, in terms of the estimation technique, the first challenge, of course, is eliminating the fixed effects in the models without triggering serial correlation of the errors, especially the threshold model. And because we have unbalanced panel data, we could not use first difference transformation, as that would magnify gaps in our data. So we use the forward orthogonal deviations transformation, which subtracts the average of all future available observations of a variable from the current value rather than subtracting the previous observation. This means regardless of the gaps in our data, all observations are transformed except the last observation in each panel. This transformation is compatible with both threshold and GMM systems, so the rest of the models have been estimated using the two-step system GMM to address endogeneity. Okay, this is the first set of results. In the first two columns, we have diversification, which is positive, but the squared value is negative. And both results are significant at the 1% level, suggesting that although diversification increases value of banks, but beyond certain level, that effect becomes negative. And that level is the threshold value shown in columns 3 and 4. In both of these columns, as 3 and 4, the estimated threshold value is 0.46. This means when a bank diversifies beyond this level, the net effect of diversification starts falling. We can also see that the effects of diversification in the lower regime is positive, which means diversification up to 0.46 increases asset value. Meanwhile, the effects in the upper regime is negative and significant. So, suggesting that diversification reduces excess value of banks in the upper regime. That is when it's above 0.6. So this is the lower regime, and the one following is the upper regime. So this table shows how information sharing affects diversification below and above optimal level. In the first 4 columns here, both mandatory and voluntary schemes have positive coefficients, suggesting that information sharing overall increases diversification in the region below the threshold. And that is what we expect, since below the threshold allow banks to create value. But in column 5, we can see that mandatory scheme has a positive coefficient, while in column 6, voluntary system has a negative coefficient. These last 2 results mean that mandatory scheme increases diversification in the upper regime, while voluntary system reduces diversification in that region above 0.46. In this table, we interact diversification above the threshold value with each of the information sharing system. The interaction time for mandatory system is negative, meaning that by increasing diversification above the optimal level, it reduces excess value of banks. The result for voluntary system, meanwhile, is positive, suggesting that it increases excess value by reducing diversification above threshold level. We use the estimations in this table to provide more understanding as to why there is diversification discount in countries with mandatory information sharing only. Then we have a higher premium in countries with voluntary system only, because beyond the volume of diversification, there might be an issue with the quality of diversification in countries with mandatory information sharing only, which means if mandatory system produces lower quality investment information, or if it incentivizes poor investment screening, it is likely to have a lower diversification threshold value than the average of 0.46. The result are, as we expect, the estimated threshold value for banks operating in countries with mandatory information sharing only here is 0.42 in the first column, while that of voluntary system only is 0.48. When you look at these 2 values, they might look close to each other in terms of value, but they are not, because about 29% of diversified banks in the study sample, are between 0.42 and 0.48. So the value suggests that mandatory scheme is associated with lower quality of bank diversification, which explains why the value start falling when earlier than in countries with voluntary information sharing only. Sorry, Victor, how am I doing with time?
Okay, Jeffrey, you are doing okay. Yeah, you are doing okay. And but I guess you are coming close to the conclusion, right?
Yes, I'm just about to talk about the robustness and then the...
Yeah. Go ahead.
Okay.
Absolutely interesting. Go ahead. Yeah.
Okay. So we have also performed some robustness exercises because a potential concern in the way our study is designed is that the factors driving the decision to diversify can be the same as those causing changes in the market value of banks, especially country level factors, or a reverse causality between information sharing and diversification, which can happen if the decision to adopt information sharing scheme is influenced by growing diversification in the banking sector. However, that is unlikely to be the case for mandatory information sharing, since the establishment of credit registry and the participation of banks are decided at the country level by the government rather than by banks. Moreover, we have addressed most of these issues in the original estimation by using the two-step system GMN to address the endogeneity and fixed effect. But we wanted to be sure that we have managed to ring fence the effects of both information sharing and diversification on excess value. So we use an index of regulatory restrictions on banking activity as an external instrument for diversification. And then internet infrastructure. Since the coverage of internet can make the process of information sharing easier, but without directly affecting bank diversification. We have also used an alternative measure of diversification, which we define as 1 minus the absolute value of the difference between net loan assets and other earning assets as a proportion of the total earning assets of banks. This measure ranges from 0 to 1, and higher value indicates greater diversification. These estimations are shown in these two tables on the screen, but as we can see, the results are similar to those achieved in the May analysis, and the new threshold value of 0. Which is the one that I have highlighted, the new threshold value of 0.469 is very close to the original value estimated in the main analysis, which is 0.469. So the difference between 0.466 and 0.469 is not much. So these are indications that our models are appropriate and the findings are robust. So here is the summary of our findings and the conclusion. Mandatory credit information sharing through credit registry increases bank diversification beyond the optimal level, and it is associated with a discount, meaning that a diversified bank is trading at a value lower than its value as a focused or specialized bank. Whereas voluntary information sharing through credit bureau reduces excessive diversification. It increases excess value, and it generates a premium for a diversified bank. These findings support our hypothesis that banks' inability to engage in higher lending due to higher monitoring of credit activities in the banking sector with mandatory information sharing present can incentivize higher investment in non-lending activities compared to voluntary scheme, which does not prevent higher lending. There is evidence of risk shifting from lending to non-lending activities in developing countries. This is a new finding which perhaps require further investigation, but it does ring an alarm bell that the protectionist principle of mandatory information sharing can intensify agency problem. Moreover, the evidence is likely to start a new debate in credit information sharing literature that has built up a consensus that it reduces credit risk overall. So, and I know some of these people, I don't know if they're in the audience today, they're going to hammer me for saying this wrong. Yeah. So, of course, banks provide valuable public goods such as access to savings and the payment systems in developing countries, which means the cost of financial distress to the economy could be significant. So it is not surprising that banking activities are heavily supervised due to this close link with the real sector. But Why does it have to be at the expense of credit growth when both are achievable? Our finding shows that credit registry performs better when it coexists with credit bureau. This coexistence changes diversification discount into a premium. But the current problem is that the coverage of credit bureau is currently too low in developing countries compared to credit registries. Therefore, voluntary information sharing through credit bureaus should be promoted by authorities in this country to improve the quality of lending and non-lending activities of banks. When it comes to how to respond to the findings in relation to agency problem, we do not believe that introducing mandatory reporting for non-lending activities is right at this stage, because that may further reduce bank investment in the economy. However, the volume and quality of bank diversification should be monitored so that individual bank with highly diversified assets can be required to share information on non-interest income generating activities. Thank you. That's where I end my presentation.
Thank you very much. Let me give you a hand of applause, Jeffrey, for sharing with us extremely interesting work and presenting it so clearly right from the start, motivating the issue of credit registry, mandatory, coexisting with the credit bureaus, which are voluntary, and how they affect bank behavior, especially in terms of bank diversification. In terms of the diversity of activities, and also in terms of the value created by banks. That should be of great interest to bank managers, investors in banks, but also importantly, the bank regulators in terms of the central bank. And there are implications for various components of the of firms or company sector. From the size of the firms may matter. So, and of course, going through the literature, drawing some interesting hypotheses. Not sure whether these have been tested for the first time, but they are all interesting, and drawing from the literature. And then painstakingly putting together a huge database across so many countries around the world, sharing with us the geography of where credit information sharing is, undertaking rigorous econometric work using threshold modeling, setting us the parameters where the cutoff point will be as you exercise the use of these credit information sharing systems, and then drawing with a conclusion that are plausible. I find it absolutely interesting. And some of this work here, the evidence is appearing for us for the first time in research, for the first time in terms of research on credit information sharing systems around the world. Now, it's appropriate now to invite the discussants for this paper, and then I will call upon comments from the floor. But meanwhile, let me invite Martin to give his views on the paper.
Thank you very much, Victor. And thank you, Jeffrey, for that fascinating presentation. Obviously, as discussants, I've had the opportunity to read the paper also, and I found it very impressive. It's a very clever research strategy. Obviously, it's multi-stage, as we've seen, and as Victor has mentioned, it's very rigorous econometrically. So the empirical work, I think, is very, very strong and very impressive. And these are important results. So they're telling us something important. And it's a very important contribution to the literature. So I really commend Jeffrey for what he's done here. And I hope we'll be able to see it published soon. Where I think it might be strengthened is in the theoretical justification. And I would raise 2 points here. The first is, can you make more of a justification for the use of the main dependent variable, which is excess value of banks? Now, the reason why I have concerns about this is that the whole problem of asymmetric information in financial markets is that it creates a social bad, a negative externality, which is that financial transactions are reduced below the optimal level because of lack of, because of the asymmetric information, adverse selection and moral hazard, as Geoffrey pointed out. And credit information sharing schemes are intended primarily to reduce this social bad, this negative externality. But excess value of banks is a private return. The fact that an excess value of banks is higher or lower tells us nothing about the social costs involved. The fact that a credit sharing scheme improves excess value does not necessarily mean anything about whether it has improved the social value, whether it's reduced the negative social cost of the asymmetric information. So I would like to see better justification for that. And in particular, I don't think that some of the interpretations that you've put on there, where you talk about, at one point in the paper, about how the mandatory credit information scheme, because it reduces excess value above the estimated threshold, that implies that it is somehow not worsening the adverse selection problem that it is meant to address. So I think that we need to be careful about what interpretations we are drawing from these results. The second issue I would raise is about the problems of suboptimal diversification and why this is occurring and how it might be handled. In the paper, and very briefly in the presentation, you talked about the causes as being driven by principal agent problems. And these are principal agent problems within the bank itself. You mentioned the problems of headquarters being able to not being able to properly monitor divisional managers, and divisional managers exploiting this to generate rents and the like. Now, and the problem I see, though, is that the credit information is dealing with a different informational problem, and that is informational problem between the bank and the borrower. It is not directly dealing with the informational problem within the bank itself. So I don't really see how the provision of better credit on bank borrowers through credit information sharing schemes can help to reduce the principal agent problem within the bank and therefore lead to less suboptimal diversification of the bank. Finally, I would like if you could clarify the way you have constructed the excess value variable. The way you have done it is by taking the actual Q, Tobin's Q, of each bank and deducting from that the adjusted Q, which is the sum of the Q1 and the Q2, the subcomponents of lending and investment banking. But I wasn't sure how you had generated the Q1 and the Q2 for each bank. Could you please explain that? I'll leave it at that, Victor.
Oh, thanks very much, Martin, for appreciating the empirical rigor of the paper. Indeed, Jeffrey's excellent job, and also for making important observations. This is work in progress. It will be jumping from one high quality journal to another, or maybe getting very good reception. And this discussion is going to contribute to the quality of the paper and enhance its exit velocity into the journal. The observations you made also are very important from the policy perspectives, and I'm sure that Jeffrey will appreciate these comments. Now, let me have the pleasure to invite Gabriel. I introduced both Martin and Gabriel at the start. So, Gabriel, please share with us your observations and comments. Thank you.
Good afternoon. Thank you very much. And thanks to Victor and Jeffrey for the paper. It's a big topic that I've spent half my life on. Just a quick comment about the perspective from which my comments are coming. I mean, my previous life, I was the head of the credit regulator in South Africa. So we were responsible for regulating both credit access as well as credit bureaus. So for me, from that perspective, credit bureaus was the tool to get the public benefit of credit access. And secondly, Jeffrey mentioned all these World Bank projects. I mean, I was an implementing agent in probably about 30 or 40 countries across Africa and Asia on both credit information sharing and on the regulation of the credit information sharing. So you must, well, let me apologize or not, but my comments come from that perspective. And partly, as you'll see just now, from some negative observation, not on the paper so much, but on our policy outcomes after 15 years of working on credit information sharing. I'm not sure that we've achieved the public benefit that we thought we would, as we being IFC, World Bank, public-minded individuals. Good. Let me be very specific. I mean, credit bureaus are such a wonderful, attractive tool from a policymaker perspective, because if you improve your information sharing through the credit bureau, and it may even only one of them, that information flows to the whole credit market. It may be 15 or 30 banks. It may be another 200 non-bank credit providers. So you actually, through one intervention, you changing the behavior in the whole credit market, which is really attractive. And you could even do it quite quickly. I mean, this could be effective within 2 years. So it's, and then from that intervention, you now reduce credit risk in the banking sector. So improve the insolvency of your bank, reduce the risk of bank failures. You presumably going to improve credit access for SMEs. SME growth means better employment. It means better exports. Credit bureaus have got hugely valuable fraud risk indicators. So you impact on fraud, you're reducing the fraud in the system. In theory, you should also be able to, through an effective credit information system, reduce your cost of credit and improve the terms of credit, terms being longer term credit, or people, I mean, in a lot of Africa countries, you would find that once credit information is available to, for instance, property rental companies, that your upfront rental deposit reduces from a 2-year rental deposit to maybe 2 or 3 months, what it would be in South Africa. So huge amounts of benefits from this one wonderful tool, an effective credit bureau. But let me move on. But for me, let's focus is that it's the rationale for doing it is, and I think I won't say it quite as elegantly, but it's the public benefit. It's the reducing the negative externalities. It's the public benefit outcomes that's our objective, rather than the bank profitability. But where I'm getting a little bit less convinced is when we use, where the focus is on the paper is on the voluntary and compulsory sharing, and using the public credit register versus the private credit bureau as a differentiator between voluntary and compulsory. At the one level, to make the one point quite bluntly, I would think most of Africa and most of Asia, private credit information sharing is also compulsory by law. If you take most of the African countries where I've worked on, your private credit bureau is licensed by the central bank and has a law behind it that makes the information submission to the private bureau compulsory, and that make even the inquiries by the compulsory. So and this would be true, I would think, in the majority of Africa and in the majority of Asia, definitely in the Caribbean. So we must be careful for that voluntary compulsory differential as a major explanatory variable, and careful of the way we differentiate between public credit registers and private credit bureau sharing. Let me move on. The comment in the recommendations. I'm being a bit malicious here, but a bit naughty. But the comment in the recommendations is that private or voluntary information sharing is a good thing, and therefore, as regulators, we should now encourage the banks to do this good thing of private voluntary information sharing. I'm very sorry, I'm a regulator. If I see something as being a good thing, then I make a law that forces them to do it. And then I check whether they do it, and I penalize them when they do not do it. So the fact that it's not done is actually already a failure in the private incentives for information sharing. And that is why the regulators intervene. And that is why in all countries except the old markets, the Anglo-Saxon markets, the information sharing is actually regulated through law, because the private incentives for information sharing failed, and the regulator said we have to force them. Let me move on. Let me just actually conclude. Let me try to pull it all together. In my context, and in my context where I've worked both as a regulator and on really quite a number of World Bank and IFC assignments, International Finance Corporations assignments, the objective pretty much always has been, on the one hand, better risk management in banks, but with a very, in parallel to that, an access to finance objective. And access to finance, I would say that implicitly, we always thought this means SME finance, or SMME finance, small and micro enterprise finance even. Now, I'm very doubtful that that objective has been met, because what I've seen in the markets where I've worked in is that what is taken off is information sharing on consumer credit. Let's be clear, there would be millions of inquiries in consumer credit for a few hundred in business credit. So what is taken off is credit information sharing in consumer credit, and then let's call it an explosion in consumer credit extension, which then, let me not get too complicated, but then obviously related to the extent to which you had automation possibilities in this consumer credit decisioning, which then linked also with your ability as a bank to control to get the salary back into your loan repayment. Now, if you compare that to SME information sharing, firstly, the reality is it has not grown nearly as fast. Well, apart from saying that, I'm saying that in some ways anecdotally, because the statistics on differentiating between consumer credit information sharing and SME information sharing is terrible. To find out what the extent of information sharing is very difficult, and neither the banks nor the bureaus have an incentive to share this information, because they know how bad it looks. Because again, let me move on, because we're sitting somewhat with the reality that we created this tool. This tool caused an explosion in consumer credit information sharing and an explosion in consumer credit, which then, by the way, moved on to quite extensive over-indebtedness, even in markets with very, very well-developed credit information. South Africa, Cambodia's two examples are many. But what has it done for SME information? we may even sit with the hypothesis, what for me would be very interesting, is to what extent has the added value add for banks and the cost recovery, cost reduction for banks on their SME lend, on their consumer lending, actually further incentivize them to shift from enterprise lending, from SME lending, into consumer lending. Because in SME lending, firstly, the banks resist sharing, even if it is not compulsory. I mean, in many, many markets, where even if it is not compulsory, the banks only share that which they want to share. So the sharing and SME information is far from perfect. Much better sharing in consumer credit information, which now further increase your profitability on your consumer credit portfolio, reduces your profitability on your SME portfolio, and shift your attention to consumer credit, which, by the way, is what we've seen in many, many markets. Explosion in consumer credit, much less growth in SME credit. One quick related point that then becomes also relevant is that what is very interesting for me from a business analysis point of view is your link between your information sharing and your bank credit processes is quite different when you compare consumer credit to SME credit. I mean, your whole appraisal process is different. So this for me becomes really, really important when we talk about how our information system translates into credit decisioning. Then there's just a few comments on the structural issue, and then I will be quiet. You've made some interesting comments there in the end of the paper around the market structure and the ownership of bureaus. These, I think, are very, very big and needs much, much more attention in literature, in practice as well. Because two or three comments is in many, many of the markets, many of the new markets where credit information sharing has been established in the last 2 decades, 20 years, you would find that it's a single bureau that manages the information sharing with government support through a law, strongly supported by places like the World Bank and IFC that says no, that they like the idea of a single bureau. But where's competition in information markets now? Are we not looking at our credit information as a market where competing bureaus will create much better outcomes? And there's quite substantial evidence from my anecdotal projects where you have a single bureau in a market such as Zambia would be an example, Morocco would be another example, where a single bureau get the monopoly, the bureau, remember what I'm talking about, over the market. And they simply make money. They have no incentive to expand the market coverage, i.e. from banks to non-banks. They have no incentive for product development because they've got monopoly in the market. So your structure of your information market is now becoming quite important. And then your structure of the banking market and your non-bank market becomes important. Now, let me just being a little bit naughty here again, just to be provocative, is in a market where you already have dominance by a few large banks, as we have in many African countries, to then have a credit information source which allows them to extend their dominance, often excluding new competitors. And I can make this even more bluntly, which is often why they're so resistant to share the SME information, because they want to protect their commercial client base. So they will happily share the consumer credit information where they have to compete and deny sharing of SME information to keep the competitors out. You now have a situation where your credit information exchange actually could exacerbate the dominance by your few players in your market. So where you now again need much more attention by the regulators of what the outcomes are that's achieved here by the structure of information sharing in your market. And then to really, and where this again, this is my life, so where this becomes quite important, you see, we put public money behind these things with intended outcomes, we must be very careful that the public money and the law that we put behind credit information sharing are not actually exacerbating or causing negative outcomes. And what I see in pretty much all the markets that I work in is this explosion in consumer credit linked to payroll deductions, linked to control over the salaries, and with corporate credit also exploding, but with SMEs, commercial credit, absolutely languishing and not growing at all. And we must be extremely careful that our information market inefficiencies are not making this even worse. Or put it the other way around, if we intervene through our credit bureau, if we see that as the tool, let's make sure that to achieve the intended outcomes. For instance, by ensuring that our SME information is also shared and shared by all the parties, not only by one or two. Enough, but it's a big topic, so don't take this too. This is a topic that I think needs so much more attention because of the extent of the impact of information sharing through our credit market and our credit allocation. Thank you very much.
Thank you very much, Gabriel. You raised quite very fundamental points, absolutely interesting, both to Jeffrey and to all of us. I was thinking also of my colleague, Isaiah Oino, who is interested now in the issue of, consumer credit. So thank you very much. Very helpful comments. We'll now go to comments from the floor. I can see one hand up, and if you want to comment also, please put up your hand. I'll start with the first hand up, who is Sandrine. Sandrine is a professor at University of Paris and is also working closely with us at the Center for Global Finance. Sandrine, please go ahead.
Thank you, Victor. I'm not very familiar with this literature, but I know that when we are talking about tools related, which are related to the credit market which help in the regulation, sometimes they exist, but they are not very effective. So I was wondering if with credit bureau and credit registry, if the effectiveness of those two tools may be taken into account in this study, and how it could impact the results. Thank you.
Thank you very much, Sandrine. Thank you indeed. Let's see if there is another hand up. Comments, observations, suggestions. I can comment on Jeffrey, but also on the discussants' comments. Let me take this opportunity also to make some observations. I think very much endorse a lot of points that Jeffrey raised. To me, it's very fundamental work in terms of looking at both information systems. I note that in the area of financial systems, financial markets, financial instruments, we sometimes have competing systems or competing metrics. For example, in risk management, we do invoke risk rating methods from Standard & Poor, from Moody's, from Fitch Ratings, and we still go with the three. And sometimes we look into the coordination of the three to look at the distance between the three measures. And right away during Jeffrey's presentation, I was thinking of the distance between, the information generated by credit registries and the information generated by credit bureaus on, say, a specific aspect, like, say, lending to SMEs. And it is quite possible to measure the distance. And we assume that if there was perfect symmetry in which case the information from both sources is perfectly aligned, then we could be able to say now, what is the quality of that data? So perhaps going into a granular issue of what information do the registries and bureaus share, which is one of the quality aspects of this research. But also, I appreciated the fact that not only is the paper and the presentation generating new work, it is also pushing us to look into future research. And I think both the comments by Martin and the comments by Gabriel were showing ways we could go beyond this work once it is completed. And I guess that gives, Jeffrey, a long-term research agenda, especially in terms of aspects trying to disentangle credit and look at, say, for example, credit to SMEs, and then, of course, again, consumer credit, which would be an absolutely new issues, and try to see how the existing credit information systems work. There is also, I think, the issue of regulator, and Jeffrey kept on coming back and forth on it to maybe a highlight of a footnote or something, in the sense that if the regulatory costs do the regulatory costs come up more when the credit registers are being implemented, and is it the case that possibly where credit bureaus play an important role, it is trying to depart from the overbearing or restrictive regulators, trying to escape from the regulators. And for me, I've really enjoyed the presentation. Very clear, absolute plausible conclusions, taking us beyond the boundaries and investigating the critical points of the threshold measures that the paper introduces. The paper, I know, contains quite a lot of robustness testing, and Jeffrey highlighted quite of those, robustness testing. It is now, absolutely standard. There are other issues which I'm sure, I know that quite sure that Jeffrey has addressed them, including issues of endogeneity and others, trying confounding effects, which might mimic different behavior of bank diversification and measurement of excess value. Absolutely great. So maybe if there are no other comments from observations from the floor, I think it will be appropriate to call upon Jeffrey now to respond to the observations by the discussants and observations from the floor, or add on your own other observations you may want to make. Jeffrey.
Yeah. Thank you, Victor. Can you hear me?
Yes, Anina, I can hear you.
Yeah, I will start with Martin's observation regarding the issue of the theoretical justification for excess value in relation to social cost. That is something that I would like to speak to him more about. But I'm going to move to the area of agency problem, because what he said is that information sharing is about addressing asymmetric information between lenders and borrowers. So the issue of agency in terms of perhaps banks and the shareholders of banks, for example, that he wanted to know more about that. But the way this works is that in the context of credit registry, because banks are unable to engage in, say, risky lending to accumulate higher And by the way, this paper is part of a series of papers that we are working on. The paper before this very one, we investigate why credit registry, drives lower credit growth. And what we discover in that paper is that to do that, because we didn't know where to start, we test all possible policies that we can find in credit market or banking sector. But one particular area that in that paper stand out is the issue of regulations, where we discover that in banking sectors where banks are stringently regulated, before credit registry is introduced, banks, especially capital regulation, what banks are doing is they lend more to accumulate higher retained earnings, then in which case that will increase the numerator of the capital ratio from the retained earnings. But when we introduce the credit registry in the model, we realize that banks change their lending policy from higher lending to higher retained earnings to lower lending volume, but to higher quality lending to reduce risk-weighted assets. So you can see the disciplinary effect of registry is coming through in whatever way you look at it, because banks are not able to engage in risky lending. That's what it is. And in this case, the issue of agency problem in this very paper is that because banks cannot accumulate higher profit from lending, then they move into non-lending activities to do so, because these activities are less monitored. These activities are not regulated. But that was why in table 5 of my presentation, I show why this is the case, that it's not just about the volume, it's about the quality. Because we discovered that in countries with mandatory information sharing only, the threshold is much more lower, which means that suggests lower quality of diversification, either because banks are diversifying into an area where they don't have the expertise, or they are finding a way to make more profit and with lower screening. So this is the whole agency problem. This is where it's coming from. That because banks are not able to engage in risky lending, then that incentivizes higher lending in lending activities. And one other area that I would like to respond to in Martin's comment is how Q1 and Q2 are estimated in my excess value measure. Q1 is simply the Tobin skew of the banks in the sample that specialize in lending activities. Is the average Tobin skew of specialized bank in relation to lending. While Q2 is the average Q of banks that specialize in investment banking. That is simply the definition. And this is a standard definition in the literature. That's why when I define it, I put up to 3 references in top journals to support this definition, including Journal of Financial Economy. So it's simply the average. That's where it's different from. So it's the average of specialized bank in the sample, in my study sample. So the Q1 is banks specializing in lending, and the Q2 is the average Q for banks specializing in lending activities. So I would just take one from because what Gabriel said is more like I was just writing notes, because it was like he was advising me literally, and which I really appreciate, and regulated. Yes, one of the things he mentioned is that is how I use the word, or how, because the way I frame the study in terms of voluntary and mandatory is from the literature. This is how it's, studies have referred to them in the literature. But the way this, the two information sharing system are used in the literature is, yes, because what he was saying is because credit bureau are private, it doesn't mean they are not regulated by say the central bank or the government. That is true. They are regulated by it's the government or the central bank, depending on who the authority in the country that will issue the license for them to operate, and they monitor their activities as well. Well, the definition of voluntary in case of credit bureau is participation. It's not in line of, because the way banks are mandated to participate in credit registry sharing. Yes, credit bureau are regulated just the way credit registries are regulated, but lenders are not mandated to participate in credit bureau. So that's the difference between voluntary and mandatory in that sense is coming from participation, not in terms of regulation. Banks or lenders can decide not to participate in credit registry, in credit bureau. So when in the study by Liberty 2022, what he discovered in One America Credit Bureau is that when banks need credit information, they subscribe to a bureau. When they don't need it, they unsubscribe. That is the difference. They're able to work according to how they need information and how they want their information to be shared. That is the difference. It's in the area of participation. So in all of the comments that I've put down, I think I will be writing to them to get in touch, because I think some of them are new to me, and I will appreciate if they allow me to follow them up and see if I can get more insight. Yeah, thank you.
Okay. Thank you very much, Jeffrey. There was a comment, but I've seen it very late because I think some participants would have liked to see the slides are responding to some of the questions and some of the measures for questions 1 and 2. But I think that's now There was also a post in the chat about why do countries have both credit registries and credit bureaus? And when you look at the data, you see sometimes some conflict of interest in the information between the two systems. Does the information conflict? Would one argue, for example, that if you have an efficient credit registry, you don't need a credit bureau, or vice versa? That's one of the questions. Jeffrey, what do you think?
Yeah, that's very interesting. Like that was explaining earlier, they are different. Like I said, in addition to one being voluntary and the other one being mandatory, credit registry simply contain information shared by financial institutions, but credit bureau are business entities. Let's put it that way. They operate business models, and they take advantage of modern technologies. They source information from even social media. They are all over different lending platforms, acquiring recent information. And in one of my slides where I spoke about how they are trying to advance their product, that particular product, portfolio monitoring, is very interesting, because credit information sharing is about screening, which is before lending. But this particular service is an exposed service, which means it allows, even after lending or after whatever business investment, it allows banks to be able to monitor their investment. So these are the differences between the two. Moreover, in many countries, credit registries have lower minimum threshold. For example, when you look at the European Union system that just introduced, I think about 2 years ago or so. The minimum threshold is about £25,000 euro or so. And that is a lot of money. So when Gabriel was talking about SMEs, that's where credit bureau is so important, because the role of credit bureau is supposed to target SMEs, because those smaller loans that credit registries don't cover, credit bureau are supposed to cover them. So that is another important difference, that you need to have both of them. And also, you have to remember that credit bureau information that they gather from different sources, it feeds into the credit registry system. Because when banks participate in credit bureau for a short time or whatever it is, information they gather, they will use it for their lending decisions. And when they are sharing their next information credit registry, this information have to be shared. So yes, there are good reasons to have both of them.
Thank you very much for that clarification. And I think it gets us thinking, of course, in terms of the data generation process, how the credit registries collect their data. I guess it's self-reporting by banks, financial service providers into the central bank. And self-reporting data is different in terms of quality and behavior compared to the system whereby the data is collected via systems where you go out and collect the data and ensure quality control of the data. Self-reporting has, there is this literature that points out the advantages and limitations of self-reporting. Of course, we are using the data that's already correct secondary data. And it may well be the case that there are opportunities of having augmenting that secondary data with primary data, in which case you have mixed methods, a type of approach to further investigation. I think you have set us off, Jeffrey, onto a path for further investigation, further insight. But for now, your work is very exciting, with a lot of evidence, a lot of our implications for policy and practice. So we do thank you. I would like to now move to draw this to a close, but I'd like to give an opportunity to Jeffrey, Martin, or Gabriel, if you have like one sentence to close the discussion. Do you have one sentence statement? It's optional. You may take it or not take it. So maybe let me first start with Martin, go to Gabriel, and come back to you, Jeffrey. Just a statement to close everything. Yeah. Okay. So Martin.
No, thanks. This has been very interesting, both presentation and discussion. So I think it's excellent work, and I hope we'll take it forward.
Thank you, Martin. Gabriel.
Yes, I can only echo that statement of Martin. I do think there's one or two little issues that really, when before you get to publications, that would need attention. I mean, information submission as well is compulsory in many private credit bureau systems. So let's, because the point I'm stressing this is, you don't want a fairly minor issue like this to discredit your main outputs. And what in the comments came out, which was very relevant, is the amount or type of information on credit registries compared to credit bureaus. Just one statement about that is, in many countries on the credit register, it is compulsory to share the bank's loan classification. So whether I as a bank classified as substandard, default, whatever it is. And in the system, that means any competing bank that sees this classification automatically do not lend if the classification is anything below fully performing. Now, that has got huge impact in the market. Some systems, your credit bureaus now try to be clever, and they try to include the loan classification in their system, which has then got massively unintended consequences. Now your credit registry, your credit bureau then start having the same negative impact on credit granting than what your register would have. So to summarize this, there is real devil in the detail in what information is shared, both at the counterintuitive level. This idea that the more you share, the better. It is not true. In credit information markets, it is really not true. And once you do your paper, I think it'll be interesting at least to comment on these in your somewhere in the paper too, just to highlight these things, because that's when it gets interesting as well and complicated. Good. Thank you very much in any case.
Thank you for those fine observations, Gabriel. Much appreciated. Jeffrey, you have the last word.
Yeah, thank you, Gabriel, so much, and thank you, Martins. I really appreciate all your comments. I would like to ask whether you are happy for me to have your contact, because I would like to get in touch for more insights, because I have really enjoyed all your contributions. If that is okay, I would like to get in touch. And for the audience, I know some of us are very busy with teaching, whatever. So please do get in touch. If you later think of any idea or question, anything about the paper, please feel free to get in touch. I would appreciate that. Yeah, thank you, Victor, for the opportunity.
Thank you indeed, Jeffrey. You made the day very interesting work. Thank you for sharing this with us. And I just want to announce also that the draft copy of the paper is available. Can be obtained directly from Jeffrey or from Meng or from myself. And this is the stage where all the comments on the paper would be helpful. Because I mentioned before, Jeffrey would like to send this paper to a high quality journal for a possible publication. And this is the stage where we can get these comments. But already the facility you provided by being here in the audience, and also for listening to this presentation, and also once again for the very, very constructive comments and observations from Martin and Gabriel, and Sandra's comments, and the comments by Charles Corrigan from the floor are very, very much appreciated. There's now, I'd like to bring this discussion to a close and look forward to seeing you again next week. Thank you very much. Let's send around a hand of applause to all of us here. Thank you indeed. Thank you.